The United States has crossed a financial threshold that can be difficult to wrap your head around: $40 trillion in national debt. It's a figure with so many zeros, it feels completely detached from your daily budget. But high debt volume on its own doesn't automatically trigger an economic collapse. Governments operate differently than households, often carrying and rolling over massive balances for decades without issue. The actual pressure point lies in the cost of keeping that debt active. Think of a typical mortgage. If you borrow $100,000 at a 2% interest rate, your monthly payment is manageable. But if you have to carry that exact same $100,000 principal at 8%, the carrying costs suddenly consume your budget. The US government is facing that exact scenario right now on a massive scale. As old, low-interest bonds mature, the Treasury has to replace them. That means refinancing trillions of dollars of existing debt in a market where interest rates are significantly higher. The long period of near-zero borrowing costs has ended. The steep price tag of refinancing the nation's balance sheet is preparing to filter down directly to the average citizen. Bond investors look at that enormous borrowing requirement and calculate the risk. Because the government needs so much capital, lenders are demanding higher returns before they hand over their cash. This creates a dangerous mathematical trap. When the government has high borrowing needs, investors demand higher yields. Those higher yields directly increase the government's interest expense. To pay that higher interest expense, the government is forced to borrow even more money. Left unchecked, this cycle accelerates. As the total interest bill grows, market participants start wondering how much the Treasury will ultimately pay just to keep financing itself. This trap sets the baseline for the entire country. What the US government pays to finance its own debt strictly dictates the absolute base cost of money for the rest of the American economy. We track this base cost through Treasury yields. You can think of these yields as a massive gravitational force that anchors the financial system, acting as the ultimate benchmark for risk and return. Because US government debt is considered extremely safe, corporate debt has to look even more attractive to compete for capital. If the government is paying 5% on a long-term bond, a private company must offer investors significantly more than 5% to convince them to buy its corporate debt instead. This flowchart shows how that expensive capital travels. High Treasury yields at the top force corporate debt rates higher in the middle, which ultimately funnels straight down into the consumer level, systematically raising the APR on auto loans, on credit cards, and residential mortgages. When capital gets this expensive, the economy feels a chilling effect. Companies freeze their expansion plans and slow down hiring. To maintain their margins while paying more for their own debt, they pass those increased operating costs straight on to their customers. So when financial reports state that Treasury yields are rising, it is a very physical mechanism that eventually extracts money directly from your wallet. Managing this cascading pressure falls on two distinct regulators, the US Treasury and the Federal Reserve. And right now, both are operating with serious structural constraints. To try and stabilize the volatile bond market, the Treasury has deployed expanded buyback plans for longer-term government debt, essentially stepping in to purchase existing bonds to keep trading fluid. But investors can see the math. These buybacks are a short-term bandage for liquidity. They do not solve the underlying reality that the government still has a $40 trillion supply of debt it needs to manage. While the Treasury tries to maintain that liquidity, the Federal Reserve is caught in a separate trap. If they cut interest rates to prevent the economy from stalling, they risk letting inflation accelerate again. But keeping rates high puts heavy pressure on the labor market and slows growth. With the Treasury deploying short-term market bandages, while the Fed attempts to balance inflation and growth, the broader economy is left navigating the volatility without a cohesive long-term cure. You would expect this severe pressure in the bond market to cause widespread panic in stocks. Instead, we are looking at a glaring contradiction. This chart breaks down the split. On one side, bonds are struggling under higher yields. On the other side, U.S. equity funds recently pulled in over $11.7 billion in weekly net inflows, while roughly 85% of reporting S&P 500 companies actively beat Wall Street earnings expectations. We have two completely different macroeconomic forces actively clashing: strong corporate profits and investor demand fighting against high Treasury yields and lingering inflation uncertainty. This intense structural tug-of-war is exactly why the economy feels so confusing to navigate. Stocks remain highly attractive, while interest rates simultaneously create a serious headwind for everyday life. A common misconception about carrying $40 trillion in debt is that the nation is going to suddenly run out of cash and default on its obligations tomorrow. That is not how the system works. The actual threat is much slower. The risk is a prolonged cycle of higher borrowing costs, relentlessly pressing down on everyday household budgets. Navigating this environment requires tracking 5 specific macroeconomic indicators: inflation data, job market weakness, long-term treasury yields, the scale of government borrowing, and the Federal Reserve's direct communications on future rate decisions. This $40 trillion debt has become a structural anchor in the American economy. The interest required to service it sets a persistent, elevated floor for the cost of capital, determining the long-term price of your mortgages, car loans, and savings.